Welcome to the Deep Dive. We're here to give you that shortcut, that quick way to get genuinely well-informed about what's going on in the global financial landscape right now. We've got a fresh stack of market intelligence reports here, and we've been digging into the powerful forces shaking up the currency markets. Our mission today, it isn't just about telling you what's happening. We want to explain why it actually matters, and hopefully give you a few of those, aha moments.
Yeah.
Okay, let's unpack this. So to kick things off, the air in financial markets, it feels pretty thick with anxiety this week, doesn't it? What are you picking up as the core reason for that really intense risk aversion? And how fast did it really escalate?
Yeah, the speed of it is truly remarkable. Intelligence sources are now pointing towards a high probability of direct U.S. military involvement in the Israel-Iran conflict. And there's even talk of a potential timeline, maybe focusing on this upcoming weekend. So this isn't just about a regional proxy war anymore. The market seems to have moved quite quickly to pricing in a significant direct confrontation. And that's a monumental shift, really, in how investors are thinking.
Right. And when investors get nervous, they typically stampede towards safety, don't they? So where's all that capital rushing? And maybe more importantly, who's being left in the dust here?
That's exactly right. It's a classic flight to safety. The U.S. dollar, being the premier reserve and safe haven currency, it's a huge beneficiary. Massive capital flows heading there. We're also seeing money move into other traditional havens, like the Japanese yen, the Swiss franc. That's a really fascinating case right now. Its role is getting a bit complicated, actually. We can dive into that a bit more later.
Okay.
But on the flip side, yeah, the commodity-linked currencies, the Aussie, the Kiwi, the Canadian dollar, they're definitely feeling a negative impact. And also emerging market currencies. The South African rand is a key example there.
It sounds like the ripple effects, then, they must extend way beyond just the immediate currency flows. What about energy markets? I mean, that seems like a critical second-order effect that could really hit everyone, couldn't it?
Absolutely, that's spot on. This conflict, it directly threatens critical oil supply chains, particularly the Strait of Hormuz, which is just vital. We're already seeing reports suggesting declining Iranian oil exports and even potential damage to key facilities like the South Pars gas field.
Oh, wow.
So this supply-side shock, it's causing a sharp rise in crude oil prices, and that feeds directly into the U.S. Federal Reserve's concerns. They've already mentioned, inflationary impacts from trade tariffs as a reason for their hawkish policy stance.
Right.
So an oil surge. That would just reinforce their whole higher for longer interest rate narrative. It creates this kind of self-reinforcing bullish cycle for the U.S. dollar.
Okay, so it feeds on itself. But it's easy to get sort of fixated on the geopolitical headlines, isn't it? Beneath that, there's another, seismic shift happening that seems just as impactful. That's the dramatic divergence in central bank policies.
Yeah.
Let's start with the Fed. They just gave us a pretty clear signal, didn't they?
They certainly did, yeah. The Federal Reserve just wrapped up its June meeting, and we're calling it a hawkish hold. Basically, they kept rates steady, 4.25% to 4.50% range. But the messaging was decidedly firm.
Okay.
Policymakers are signaling maybe only 2 rate cuts anticipated for all of 2025. And their primary concern, it really remains rising inflation, maybe exacerbated by those import tariffs. It's a very cautious stance, very data dependent, clearly indicates they're in no rush at all to ease policy. And then in stark contrast, you have the Swiss National Bank. Just wow. An aggressive and completely unexpected 25 basis point rate cut.
Unexpected. Really.
Totally unexpected by most of the market. It drives their policy rate down to 0.000%. Zero. It's effectively, you could call it unilateral monetary disarmament. They're clearly prioritizing stimulating the domestic economy, countering deflation. So just imagine that. A traditional safe haven currency that suddenly offers no yield. How long does it really stay safe in investors' minds?
Yeah, that's a huge question.
That's the profound shift the S&B just engineered. It fundamentally alters the whole calculus for the Swiss franc.
Okay, and just to sort of round out the picture of this divergence, the Bank of England, they're on a dovish hold, right?
Yeah.
4.25%. But there was that split vote, 6-3, which kind of indicates maybe an inclination towards future easing.
Exactly. That split vote is key. Shows the committee is leaning more dovish. And then the European Central Bank, they're also on a decidedly dovish path. Their main rate is down at 2.15% after they recently cut.
Right.
And of course, you've got the Bank of Japan, still sticking with its ultra-accommodative policy, just 0.50%.
So the gap is just enormous in some cases.
It is. And what's really striking here is how this vast difference in central bank thinking, it creates entirely new dynamics for currency values. It's not just about one central bank anymore. It's about the powerful, sometimes opposing fundamental drivers that just emerge from these stark differences across the board.
Yeah, absolutely. Okay, so beyond the headlines, beyond the central banks, so let's look at the market's internal workings,
Yeah.
the positioning. Are there any particular structural things that are maybe amplifying these movements right now?
Yes, definitely. One thing to keep in mind for the upcoming U.S. session is the Juneteenth federal holiday. U.S. stock and bond markets will be closed, and that means substantially reduced liquidity.
Ah, okay.
And you know what happens with low liquidity? It can dramatically amplify price volatility if any new headlines drop. So even small news items can suddenly have these really outsized impacts on prices.
Good point. Something to watch out for. Now, this next point about market positioning. This feels like where we really start to see some, well, hidden vulnerabilities. Walk us through the Commitment of Traders report, the COT report. What's revealing about where the big money is truly parked right now?
Right. The COT report is crucial here. The latest data reveals a massive net short position in the Japanese yen held by large speculators. We're talking nearly 170,000 contracts short.
Wow, that's huge.
It is huge. And it's not just about, big money betting against the yen. It's about how crowded that trade is and how quickly that bet can just explode in their faces, potentially forcing them to buy back yen at any price to cover their short.
Right, the squeeze.
Exactly. That creates a significant risk of what we call a violent short squeeze, which would mean rapid explosive JPY appreciation, particularly in those JPY cross pairs. And we're also seeing significant net long positions in the Australian dollar and, crucially, the Swiss franc. Almost 20,000 contracts long CHF there.
Okay, so that sets the stage perfectly. We've laid out these overarching forces, the geopolitics, the central bank divergence, the market positioning. Now it's time for our deep dive into specific currency pairs. We've handpicked 5, chosen for, well, their volatility, their liquidity, and the compelling stories they tell right now, because these are the pairs that really show how these global forces are playing out on the ground. So we'll break down the outlook for each. Let's start with our highest conviction forecast, USD CHF. You're saying the outlook here is strongly bullish. What makes this one so clear?
Yeah, this really is the clearest narrative in the market right now, I think. The fundamental case for USD CHF is, well, exceptionally strong, and it's because of that stark monetary policy divergence we were just talking about. It's the starkest we've seen recently. You've got the Fed hawkish hold 4.25%, 4.50%, and then the S&B cutting aggressively down to 0.
Zero.
That's an interest rate differential of over 450 basis points. That creates just a powerful kind of unidirectional tailwind for this pair, pushing it higher. And that ties directly into sentiment, you see. The S&B's unexpected rate cut, it severely tarnished the CHF's traditional safe haven appeal, almost instantly.
So it lost its shine.
Pretty much. And those speculative long positions in the CHF we just mentioned, those nearly 20,000 contracts,
Yeah.
they're now effectively trapped. They're unprofitable. And this creates a really high likelihood of forced selling CHF to buy USD, which of course will only fuel the rally further. It's like the market is basically saying, look, we don't care that you used to be safe. You offer absolutely no yield now.
Right. Makes sense. And the technical picture for USD CHF, it certainly seems to agree with that story. Looks like a strong bullish posture breaking out of that multi-month descending channel on the charts. And even the AI-driven models are apparently heavily skewed to the upside here.
It definitely raises an important question, for you, the listener. How quickly can a traditional safe haven currency lose its primary appeal when its fundamental yield basis shifts so dramatically? It's just literally to 0. It forces a complete rethink, really, of how investors view the franc.
Okay. Very compelling case there. Moving on then. Let's look at Euro ED. The projection here is decidedly bearish. Why is the outlook so negative for the euro against the dollar right now?
Yeah, the fundamental backdrop for Euro D is indeed decidedly bearish, and it's primarily because of that widening interest rate differential we keep coming back to. You've got the Fed's hawkish stance versus the ECB's dovishness, and remember, Eurozone inflation is pretty low, just 1.9%.
Right.
So the U.S. dollar simply offers a much, much more attractive yield right now. Then from a sentiment perspective, you look at the CBOE volatility index, the VIX, the market's fear gauge. It's above 20.
Which is quite high.
It is. And you've got a strong U.S. dollar index measuring the dollar against a basket of currencies above 98.90. Both of those reflect a general risk-off environment, which tends to benefit the USD. We're also seeing some signs maybe that institutional players are unwinding their euro-long positions. Open interest in Euro FX futures has seen a significant decrease. Suggests weakening conviction in the euro, perhaps?
Okay. And the technical analysis for Euro USD, that seems to reinforce the bearish view too,
Yeah.
showing persistent pressure, struggling to get back above that uh, psychologically important 1.1500 level.
Yeah.
And the momentum indicators look pretty firmly pointed down.
That's right. The technicals are aligning with the fundamentals and sentiment there.
Okay. Next up, let's talk about the dragon, GBP JPY. The projection here is also bearish. This pair is known for its aggressive moves, isn't it? So what's truly driving this negative outlook?
Yeah, GBP-JPY is a complex beast. It's often called a high beta risk proxy, meaning it's highly sensitive to overall market sentiment. It tends to exaggerate global risk moves, both up and down. Now, normally, the interest rate differential would favor the pair, right? The Bank of England's rate is significantly higher than the Bank of Japan's.
Yeah.
But the BOE's recent dovish tilt with that 6-3 split vote we mentioned, that definitely weakens the GBP side of the equation. But crucially, this pair is just extremely sensitive to global risk-off sentiment. Combine that with the acute risk of a JPY short squeeze.
Ah, the squeeze risk again.
Exactly. That massive short position we talked about. Put those together, and you really have a powder keg scenario for GBP-JPY. Any trigger, maybe more geopolitical news, maybe just a shift in sentiment, it could cause a rapid, potentially severe drop as those huge short JPY positions are forced to cover.
A powder keg. That sounds worrying for anyone long. And the technical indicators, are they flashing warning signs too?
They are starting to show signs of exhaustion for the bulls, maybe a shift to a more short-term bearish bias. And the AI simulations we look at are also flagging a high probability of increased downside volatility. So yeah, it's a real watch out for this pair.
Okay. Now, USD JPY, this one's projected as sideways but volatile. Why are there such conflicting signals here? It almost feels like the market just can't make up its mind on this one.
You've hit on it exactly. That's precisely the situation. This pair is caught in a really intense battle between conflicting market forces. It's a genuine tug of war. On the one hand, you have that powerful fundamental tailwind from the massive interest rate differential. Fed at 4.25%, 4.50%, BOJ still way down at 0.50%.
Which should push it up.
Unequivocally, yes. That should push USD JPY higher. But UKT, you have the escalating geopolitical risk, which is driving safe haven flows into the JPY. And when both currencies in a pair are attracting safe haven bids for different reasons, the result is often this kind of choppy, range-bound price action. The pair gets pulled in both directions.
Okay, so risk off helps the yen, but the yield gap helps the dollar against the yen.
Precisely. And we simply cannot overemphasize that massive, historically large net short position in the JPY again. It just makes the market exceptionally vulnerable to a short squeeze. And that vulnerability explains why we're seeing such volatile, whipsawing, range-bound price action. The market's constantly being pulled strongly in two opposite directions.
And the technical analysis, I assume, reflects this indecision.
It really does. The pair seems trapped in a pretty well-defined range, let's say between 142.35 and 146.00 roughly, and the AI-driven models. They also show something interesting, a nearly symmetrical probability distribution, which basically acknowledges the elevated risk of a volatile breakout, but it could be in either direction.
Huh, fascinating.
And if we connect this back to the bigger picture, this pair, USD-JPY, it's almost a microcosm of the current market's fundamental tension. That tension between seeking yield and avoiding risk, it really encapsulates the central dilemma facing investors in today's global financial picture.
Right. A real puzzle. Okay, finally, let's discuss USDZR, the US dollar versus the South African rand. You described it as the premier proxy for emerging market risk. And the outlook here is bullish for USDZR. What's driving that strong projection? Seems like a clear indicator of global sentiment.
It really is. Its outlook is strongly bullish, yes. And it's driven almost entirely by that global risk-off environment we've been discussing. When investors get nervous globally, they tend to pull capital out of riskier emerging markets like South Africa and pour it into the perceived safety of the US dollar. That's just a powerful headwind for the rand, the ZR.
And there are domestic issues too, right?
Exactly. On top of the global picture, South Africa has its own weak domestic fundamentals. The unemployment rate, for instance, climbed to a staggering 32.9% in the first quarter of 2025.
Wow, 32.9.
Yeah. And these internal weaknesses, they just amplify the ZR's vulnerability during these global risk-off episodes. It means its interest rate differential, which might otherwise look attractive, gets completely overshadowed by the risk aversion.
Okay. And the technical picture, does it support the bullish view?
Yes, the technicals are showing strong signs of a potential bullish breakout, characterized by high volatility and pretty rapid acceleration recently. The AI models are also forecasting a high probability of continued upside for USD ZAR, so multiple factors pointing in the same direction here.
Okay, so bringing it all together then. We've covered a lot of ground today. We've looked at these varied outlets, different confidence levels across the pairs. The USD CHF really stands out, doesn't it, as perhaps the most compelling narrative, driven by that stark policy divergence.
Mm.
And that JPY short squeeze risk. Wow, that just seems like a major wild card hanging over multiple pairs. It could affect, well, everything.
Indeed, absolutely. Understanding these interconnected forces, the geopolitical risk, the central bank divergence, and the market positioning, it's absolutely key to making sense of these global financial movements. It really encourages you, the listener, to consider multiple perspectives and to maybe question assumptions about how markets usually behave. Because these aren't isolated events, are they? They're all parts of a complex, constantly evolving puzzle.
Right. So as we bring all these threads together now, we want to ask you, what stands out? What's the single biggest takeaway for your own understanding of these markets right now? How does this deep dive maybe empower you to navigate the financial news better, perhaps, prepare for that next big meeting, or maybe just feel a bit more informed about the world's incredible and sometimes baffling complexities? So as we wrap up, let's just quickly remember the core themes from today. That overriding influence of the Middle East conflict on market sentiment right now, the dramatic policy shifts from central banks creating these stark contrasts, and that precarious market positioning, especially in the Japanese yen.
Yeah. And maybe as you go about your day, here's a final thought to consider. If a regional conflict over here and a central bank's unexpected policy pivot over there can so dramatically reshape global currency flows, what other, maybe seemingly unrelated events are quietly brewing right now? Events that could be ready to trigger the next seismic shift in our really interconnected financial world. Something to think about.
Absolutely. Food for thought. Well, thank you for joining us on this deep dive. Keep exploring, keep learning, and we'll see you next time.